Welcome to the Chapter 18 video lecture, Video 18A. This video is all about corporate distributions and how earnings and profits, which is a tax term, help us define the character of a corporate distribution. Let's get started. Recall that basis is the investment that you get back tax-free. So Severus invests in Snape Inc. by buying $1,000 worth of stock. Severus sells the stock a few days later for $1,100. So we know now that he gets his $1,000 back tax-free. That's what the concept of basis represents. So let's instead assume that Severus contributes $1,000 to form Snape Corporation. And what Snape Corp does is it puts the $800 worth of money to work immediately by buying some assets, and then it generates income of $150. So its balance sheet at the end looks something a little bit like this. So we've got cash at $350, that's $200 left over from what what Severus contributed, plus the $150 of income that it's generated. It's got that $800 asset that it bought, so total assets of $1,150. It has owner's equity of $1,000 and retained earnings of $150 to top out its liabilities plus owner's equity. So we have a nice, simple, clean balance sheet. So let's say that the corporation, so Snape Corporation, makes a $100 cash distribution to Severus. Let's assume that that comes out of earnings. As a result, that's a dividend, right? So we know that the corporation made $150. It's distributing $100 of those dollars to Severus. That's the classic example of a dividend. What if instead it makes a $200 distribution to Severus? Okay, well now it's clearly distributing $150 of the earnings, but it's also returning what must have been some of Severus's own investment back to him. So it's returning a piece of his capital to him, isn't it? Because it's only generated $150 of earnings, so the only other way it could have generated money is if it's giving Severus some of his own money back. So let's do a quick modification. So in this case, Snape Corp borrows $200 from a bank. And at the end of the year, it liquidates the asset. So basically, think of it as it borrows $200 and then immediately liquidates the asset that it used to generate income. So basically, it's placed all of its assets now in the form of cash. It's liquidated everything, and all that has left is $1,350 of cash. So that's the $1,000 Severus put in, the $150 that the corporation generated in earnings, and then the $200 that it borrowed from the bank. So now on the liability side, we see that $200 bank liability, we see owner's equity of $1,000, and the retained earnings of $150 that we're used to seeing. So let's say now that Snape Corp makes a $1,200 distribution to Severus. Okay, let's march through where that money came from. So $150 of it came from the earnings of the corporation. $1,000 of it came from Severus's investment. So he's received back everything that he put in, plus $50 more that came from, well, let's face it, someone else. It came from the bank. When that corporation makes a distribution of that $50 to Severus, that's his money now. That means that's income under the claim of right doctrine. And that is precisely how we characterize distributions from a corporation to its shareholders in respect of the shares. First, it is treated as a corporate dividend to the extent of the earnings and profits of the corporation. And E&P is a magical term. We're going to talk about it a little bit, but I'm never really going to make you define it in full.
Karl, schieß dem Fenster. Shoot the glass.
Then, once all the E&P is used up, right, once all the corporate earnings and profits have been distributed, then it would be a reduction of the shareholders' basis until their basis is zero. So in our previous example, Severus had basis of $1,000. That was his investment. As the distribution comes out further and further, right, and it erodes away his basis, his investment, until it gets to zero. And then anything that's beyond that, well, that must be a gain because that money came from somewhere else. Okay, so characterization of this distribution from a corporation to a shareholder obviously has important tax consequences, right? The non-deductibility of the distribution by the corporation, coupled with the taxation of the distribution on the dividend, well, that creates the double taxation we have just been beating around the head and shoulders this entire module. Double taxation of distributed corporate income is a fundamental principle of the U.S. income tax system. That is not true around the world. There are plenty of systems that do not treat corporate income as double taxed. Germany is one that comes to mind. The recipient of the dividend or payment in exchange for corporate stock generally receives preferential tax treatment on the distribution. Now, this is actually something that George W. Bush implemented, so it's not that old, although for most of you, that's probably older than you've been alive. I hate to say this. So in any event, there's the reduced tax rate that we've become so accustomed to, the 0, the 15, or the 20%, or it comes out as a tax-free return of capital, right? A return of your basis, or of course it could be both in some of the examples we've seen, depending on the dollar amount. So if the distribution is characterized as salary, bonus, interest, rent, right, those items, like we have talked about in trying to mitigate the double taxation, then of course it does mitigate double taxation. But if that distribution really looks and feels like a dividend, then the IRS is going to try to assert that that's a dividend. So examples that we've run into are things like overstating the amount of salary that you're paying a shareholder, right? So, of course, we know now that if the distribution is treated as compensation, both the corporation and the shareholder pay employment taxes on that distribution. And given kind of the current rates of employment taxes, that can be brutal. But if we think about a closely held corporation that has a wealthy corporate investor, 100% owned, and it pays out hundreds of thousands of dollars in compensation, remember that what happens is that compensation is down to a 2.9% rate because they've blown through all of the FICA cap. So Social Security doesn't apply anymore. And Social Security is the larger share of employment taxes. Okay, so again, tax law definition of a dividend. Any distribution of property made by a corporation to its shareholders out of its earnings and profits account. So there are actually two separate earnings and profit accounts that have to be maintained by a corporation. Current earnings and profits and accumulated earnings and profits. And the only way, like the substantially identical, no, that's not the right term I'm looking for. So the concept that probably you can closely analogize this to is retained earnings and net income. So think of current earnings and profits. That's the earnings and profits being generated that year, like net income. Accumulated earnings and profits, that's the earnings and profits that were generated in prior years. And like income getting rolled into retained earnings, current earnings and profits, ultimately, if it's not distributed, gets rolled into accumulated earnings and profits. Think of it like kind of on the first day of the next year. It's really on the nanosecond of the change in year end, but neither here nor there. So current E&P, here we go. Current E&P not distributed is added to accumulated E&P at the beginning of the next taxable year. Okay, so how do we calculate this magical earnings and profits? So obviously, you know that corporations generally maintain accounting systems because a corporation under tax law, along with any public corporation, is required to keep books and records. So as long as they're keeping those books and records, we typically think of E&P as being some form of taxable income that's adjusted. So, and those adjustments are ones that the Internal Revenue Code requires you to make with respect to E&P. So conceptually, earnings and profits is a little bit like book income, or maybe some form of book income that ties to economic income, or maybe something in between that. It's kind of its own thing, but when we think about the earnings and profits, it's more closely related to book income sometimes than taxable income. So adjustments fall into four broad categories, and I'm telling you that this should feel a lot like the same categories that we saw in M1. So inclusion of an income item that is excluded from taxable income. So That would be, let me give you a great example, municipal bond interest. So municipal bond interest is not part of taxable income, but it is part of earnings and profits, just like it would be part of book income. A disallowance of certain expenses that are deducted in computing taxable income, but do not require an economic outflow. Oh, I don't know if I can come up with a good example of that one, not off the top of my head. The third one is deductions of certain expenses that are excluded from the computation of taxable income, but do require an economic outflow. That's like the 50% for meals and entertainment. Non-deductible expenses, those are all allowed to be deducted for E&P purposes. And then lastly, deferral of deductions or acceleration of income due to separate accounting methods required for E&P purposes. So something along the lines of E&P doesn't respect the installment method. So as a result, you would recognize the entire gain within the period under E&P, whereas for installment method, we know that we get to defer that recognition over time. Okay, so here's some examples of each of them. I'll let you read those if you want to. Oh, dividends received deduction. That's the one I couldn't come up with. Okay, so there are 4 possible states of earnings and profits. Okay, we can have positive current E&P and positive accumulated E&P. Positive current E&P and negative accumulated E&P. Negative current E&P, positive accumulated E&P. And then negative current and negative accumulated E&P. So it looks a little bit like this if you need a graphic representation. And the only reason I bring this to your attention is that the way we characterize a corporate distribution depends in large part on whether we are, which of these 4 states we are in. And we have to be in one of these states. Well, I guess technically you could have 0 E&P, 0 current, 0 accumulated E&P. Okay. So let's deal with each one of these different scenarios separately. Let's start with current positive, current accumulated. Okay, so I've got positive current E&P of 1.2 million. I've got positive accumulated E&P of 500,000. And on July 1st, so in the middle of the year, this is a calendar year in corporation, the corporation distributes $1 million. Okay, so the way the rule works is said when you are in a positive situation, first, the entire distribution is deemed to come from current E&P, and then accumulated E&P. And obviously, it's a dividend to the extent of either of those. So in this case, the first place I would look is current E&P. That's 1.2 million. Well, that covers the entire distribution. So as a result, I would end up with 200,000 of remaining current E&P that would then roll in at the beginning of the next year to accumulated E&P. So I'd start next year with 700,000 of accumulated E&P. Okay, so one of the unique perspectives we need to understand immediately is I am unable to characterize a distribution out of positive current E&P until year end, because I do not actually know how much E&P I'm going to generate that year. So what that means is even though the distribution was made on July 1st, the corporation does not actually know the character of that distribution until December 31st, in which time it can calculate current E&P. Okay, example 2. I've got positive current E&P and I've got negative accumulated E&P. So positive current E&P $1 million, negative accumulated E&P of 500,000, same distribution of $1 million on July 1. So when I have positive current, negative accumulated, the entire distribution is deemed to come first from current E&P. So as a result, because I have $1 million of current E&P for the year, all of it comes out of current E&P. And this is true even though at year end, I would only end up with total E&P of 500,000, right? The million plus the loss or the deficit of 500,000. It doesn't matter. The rules require you to deem it as it came first from current E&P because current E&P is positive. Okay? So again, part of this is just understanding the rules. Now let's think about the way, especially on this second one worked. If I have positive current E&P and negative accumulated E&P, and I'm required to bring it out of the positive amount first, it's pretty safe bet that I'm more likely to create a dividend distribution. A dividend distribution creates the double tax. That's exactly what the service wants. So these rules are structured in a way to generally maximize the dividend over the return of capital. All right, let's go on to our next scenario. Now I've got negative current E&P and positive accumulated E&P. So negative 600,000 current, positive 500,000 accumulated. Again, I have the exact same distribution of $1 million on July 1. When I'm in this situation, what I'm supposed to do is determine what is total E&P on the date of the distribution. So how do I figure out what total E&P is on the date of the distribution? Well, recall that accumulated E&P came in from last year. That's 500,000. Current E&P is 600,000. The way you're supposed to do that is prorate it over the number of days in the year. So since the entire year generated a loss of or negative E&P of 600,000, that means halfway through the year would be 300,000. Now, technically, you're supposed to use the exact number of days. But for all the examples we're going to do, we're just going to split the year in half because that's just way easier to do the math. I'm trusting you guys could do 182 over 365 if I asked you to. In any event, total E&P on the date of the distribution, which is halfway through the year on July 1, therefore, is 200,000. As a result, 200,000 of that distribution is a dividend. The rest of it then would be applied against whatever basis the shareholders have, and then beyond that it would be capital gain to them. All right, our last iteration, which is number 4. I have negative current and negative accumulated. Well, this one is actually the easiest one. The corporation distributes the same $1 million on July 1. Since there is no positive E&P, none of it can be a dividend. It would go first against the shareholders' basis, and then ultimately it would be a gain beyond that once they've zeroed out basis. Okay, so just quickly, so we understand, we talked about this a little bit. The IRS has the power to recharacterize unreasonable distributions that are categorized as deductions. So unreasonable compensation, right? I think we did an example in Module 2 where we talked about a corporation that decided to treat as wages the entire amount of corporate income, no matter what it was. That's probably unreasonable. A bargain sale to a shareholder, right? So it owns a piece of property. Let's say it's a piece of land, right? So the corporation owns a piece of land and it sells it to the shareholder for $1 when the market value is clearly greater than that. So what would happen is the IRS would come in and say, wait a second, the difference between the dollar and the market value, that was just a dividend or that was a corporate distribution, and as a result, to the extent there's earnings and profits coming out of that and being treated as a dividend. Shareholders' use of corporate assets without an arm's length payment. That's kind of the same as the sale, except this time there's no transfer of ownership. So they use the corporate car, you use some other form, you use the corporate apartment for personal living, use the corporate jet. That's a pretty popular one. Those would all be things that would be construed as a constructive dividend. Loans from shareholders at excessive interest rates. So this one works a little bit the opposite, right? We know that we want the interest expense on the corporation to be deducted and create income to the shareholder in order to avoid double taxation. So we claim that we loan them money at 50% interest rate, which simply isn't reasonable. Obviously, that jacks up the deduction amount, but since it's not reasonable, that would be treated as a corporate distribution to the extent of E&P, a dividend. And then lastly, corporate payments made on behalf of the shareholder. So that's just kind of the form of the payment from the shareholder's use of corporate assets, right? So if instead of paying their own mortgage, the corporation pays the owner's mortgage or the shareholder's mortgage, that sort of thing. Thanks for watching Video 18A on earnings and profits and corporate distributions. See you in Chapter 19.
Nice suit. John Phillips. I have to tool myself.
Many of you are surely wondering why I have summoned you at this hour. It's come to my attention that earlier this evening, Harry Potter was sighted in Hogsmeade. Now, which one of you can tell me the difference between an animagus and a werewolf? No one. How disappointing. 5 points from Gryffindor. Gillyweed, am I correct?
Sorry, Hans, wrong guess. Would you like to go for double jeopardy where the scores can really change?
Know what it is?
These are very bad for you.
A rather rare herb, Gillyweed. Not something found in your everyday garden.
Whoa.
That is the second time you have spoken out of turn. Are you incapable of restraining yourself, or do you take pride in being an insufferable know-it-all?
Yippee-ki-yay, motherfucker.
Expelliarmus!
The code, please.
It's useless to you. There are 7 safeguards on our vault, and the code key is only one of them. You'll never get it open.
Then there's no reason not to tell it to us.
I told you. It's not over yet.
It's a very nice suit, Mr. Takagi. To be ashamed to ruin it. I'm going to count to 3. You give me the code. 1, 2, 3.
I don't know it. I'm telling you. Get on the jet to Tokyo and ask the chairman. I'm telling you, you're just going to have to kill me.
Legitimate!
Severus, please.
Now I have a machine gun.
Ho, ho, ho.
Well, I hope that's not a hostage.